And welcome to Freightonomics. Anthony's mental health is still strong and standing for now, so he is still with us. Our chief economist, Anthony Smith. I'm Zach Strickland, head of freight market intelligence here at FreightWaves, and we are here to really talk to you about just about everything possible. Some weeks we don't have as much content that kind of drives the discussion, but this week, Anthony, we were talking about it before the show, it's literally every angle imaginable in terms of supply chain, freight market analytics. I, of course, have to geek out a little bit on the earnings and the financial sector, but there's more than that. We had the federal rate increase another quarter, 25 basis points, as well as some interesting stuff from the jobs markets. And we just got to jump right into it, Anthony.
Yeah, and of course, this is our first show back Thursdays at noon. So thank you all so much for tuning in and sticking with us through some of the little time changes and shifts here. But Zach, like you said, we got to jump straight into it. Do we kick it off with Freight in 2?
Yeah, let's do it.
Starting it off in 3, 2, 1.
All right, the first chart, I've been leading off with it. I told you this is what you're going to get from me for the time being until I see a reason to change the OTVI, but this is on a monthly cadence, and this is the last 4 years of outbound tender volume index on a monthly organization. So the white line is the current year. You can see January, we just closed January just a little while ago, so we now have January, and you can see there's a slight uptick in volume. However, we normally uptick off of December because we have a few weeks of vacation time. It does look like we are following a similar trend line to what we would see pre-pandemic. If you look at the orange and purple lines, those are the two pre-pandemic years. The pandemic era, of course, in the blue and green line. Now, interesting thing is that the first deterioration we had was during the pandemic era as volumes fell on that blue line into January. That is not the case this year. And of course, there's a huge reversal of that trend in February. Let's go into our next chart here. Outbound tender rejection index compared to the spot market. Absolutely nothing to see here. Spot rates have now hit their low points that they hit in mid-February a few days, actually a day earlier than I projected they would. So it was a little off there, but we're now at the market bottom in terms of spot rate activity. Tender rejection rates barely moving, 3.78%. I think we're at 3.75% this time last week. Next chart. We did have a Texas freeze event this week. Dallas, of course, had an ice storm, so I wanted to point this out. Tender volumes, they're in white, they're in green. They jumped in front of the ice storm, and then tender rejections jumped as the ice storm hit, but volumes fell. The lesson here, if we go to the next chart and finish it off, that big circle there, that's the Texas freeze. Volumes fell, tender rejections jumped, and then afterwards, volumes soared. Watch out, Texas.
Impressive stuff, Zach.
Yeah, that's kind of the lesson of these natural disasters is like, okay, maybe capacity doesn't tighten. Donnie and Thomas talked about it this morning on FreightWaves Now a little bit. So definitely check that out. But volumes fall when you can't get to work. Yeah. Like the shippers shut down. I've seen this happen with Harvey in Texas. Texas is like the centroid of all this activity. Now that I think about it, I just put that together, where Texas volume tends to be like the most volatile or reactive to some of these natural disasters because it's a central point for a lot of freight.
Yeah, and I mean, I think you bring up a good point because we've seen there was a Texas freeze not too long ago, and I think we're kind of seeing some of the stuff that it's not the same, but some of it I'm sure rhymes.
Yeah, it's one of those things where everybody thinks that during the event is where all the capacity tightness begins, but it actually occurs after the event passes because think about it, the rest of the country operating as normal. Right. And then we have, this portion of the supply chain shut down where they can't ship anything for a few days. Right. They can't produce something. There's a distribution center that's shut down in the middle of Amazon's network, and I don't know that to be the case. I just said that as an example. But that's the type of thing that causes these like huge spikes in activity, tightness to show up, kind of unseasonably so. So definitely watching Dallas for some disruption.
Definitely going to be watching for sure. And You see me looking down, that's because I'm on LinkedIn. So if you're actually in the supply chain and you're in the Texas area, what are you seeing right now? I want to jump in on the conversation through any of the talks that we're talking about today, because if you're watching right now around 12 o'clock Eastern Standard Time, we are live, we're streaming live. So jump in on LinkedIn, get a part of the conversation, and we'd love to hear from you.
Yeah, so I mean, the Texas freeze thing doesn't look like it's going to be on the scale of what we saw in 2021. Yeah. Obviously, the market a lot more sensitive to these disruptions back then. And of course, shippers also hadn't realized that there was going to be this huge demand surge coming out of it. So, and that was really macroeconomically, there was still a lot of demand going on in January because we're still shut down.
Right.
And we had a stimulus package.
Right.
Something the shippers did not foresee. And so these companies had to order and their supply chain was all clogged up, so they weren't getting the orders. That's absent this time. But there's still some pieces that we can pull forward. And speaking of demand, Rachel Premack wrote an article.
News-onomics time, because we got to keep it moving here.
Yeah, and we got a lot to cover. Rachel Premack wrote this article about boxes.
Yeah.
What did you take away from this article? You talked to her this week.
Yeah. So we were able to have her on FreightWaves Now talking about the article. And I think it was very well written. And I think it's definitely just one of those additional interesting data points that kind of confirms what we've been seeing and what we are expecting. Of course, it kind of captures, it was data that was year-end data, I believe, and throughout the fourth quarter.
Yep.
And so definitely kind of shows one of those other areas of like, yeah, there is some significant decline in that consumer demand. Also, it kind of is going to be reflective of the heightened demand that we saw from the earlier parts of the year.
Yeah, and I think that's the point. Is, it says that the headline here is cardboard box demand plunging at rates unseen since the Great Recession. Now, when we were falling out of when things were deteriorating in the Great Recession, we were operating at kind of this standard line of activity. It was up and to the right, but it was this, pretty strong economic growth cycle we were in, and then it fell. Now we hit a plateau of activity. I mean, if you look at the OTVI, the Outbound Tender Volume Index, we really hit a ceiling of activity for about a year and a half, and then it started just falling off. So the rate of decline there isn't the same as the rate of decline. You can't compare those two perfectly, but the point being, we're economically slowing.
Yeah, and I think it makes all the sense in the world when we're looking at what's going on with the consumer. Of course, we'd always talk about it. Savings rate staying low. We're seeing, of course, the credit utilization continue to rise, showing that there's going to be fewer dollars to be able to spend potentially on a lot of these goods. And now you're going to have to make those decisions between goods and services. And on top of that, we're seeing a lot of mixed signals, of course, coming from the jobs market, which isn't a leading indicator per se, but definitely something that's going to show what some of the current consumer conditions are that they're going to be leaning on to really kind of continue to make some of these purchases.
Well, let's talk about that for a second, because now we've got a good moment, especially considering that the consumer is the one buying Amazon, ordering stuff online. These boxes, obviously, the box industry has grown significantly from the consumer sector. So tell us about the jobs market, because that's the thing that the Fed has been leaning on, saying, look, we're still doing all right, people, even though anybody looking at transportation demand is saying, like, the sky fell.
Yeah. So, I mean, the job openings number is definitely one that I think Jerome Powell mentioned in his latest talk that he just gave just yesterday. Also concluded with a 0.25% bump in that interest rate, but definitely noting that there is for sure an imbalance in the labor market, and so that there's going to need to be some type of correction there. So Jerome Powell mentioned that he is, confident that there is a reality or is a scenario where there can be a correction in the labor market without detrimental harm or contraction within macroeconomic growth overall. And so I think that is definitely a fine, needle to thread there. But I think, for that to happen, there's just going to have to be so many things that have to fall into place, one of which is we saw pretty surprisingly or impressively that the hirings picked up in December. So this is also lagged data. But what we've been seeing really over the last year or so is that even though we've seen crazy number of job openings, that we saw that hiring wasn't quite keeping up with that. And so we actually saw a tick up in hiring this month, which was pretty, nice to see and encouraging to see, because I want to see, folks be able to get out there and get a job. I don't want to see everyone just laid off. But the quality of jobs is definitely going to be the big thing around that. A lot of it's going to be around services. We're looking at the job gain for one of the ADP reports for the private sector. A lot of job gains, even though it slowed down overall, were for the service sector, while the jobs for producing goods actually contracted or went down.
Yeah, but I mean, even if they are jobs for the service sector, that means that people stay employed and they can spend money on goods and other things, and that keeps things rolling, and that's good. What we don't want is what we hear in the headlines, and that's like layoffs happening every week. And obviously, some of these companies, it's been very tech-heavy layoffs from what we've seen. It's not ubiquitous. It's not throughout the entirety of the job spectrum. So I guess that's still some positive news. That's some positive takeaway. That's the thing I'm holding on to as consumers continue to kind of spin themselves into this hole that I see forming, and that's my most concerning piece is the debt. The credit card debt is still growing.
Yeah, the credit card debt's still growing. The non-revolving credit is still growing. And I think we talked about some of this on the last episode, but just the mentality of some of those employers are going to be different now post-pandemic. And so, of course, at the pandemic, we saw that there was this huge, massive wave of layoffs. And then, it's like, all right, now the scramble to get everyone back to work and hire as many people as we can. I think a lot of employers are going to probably try to hold on to labor a little bit longer, potentially, than they should. And so that could be potentially a detrimental thing for a lot of companies and a lot of individuals as we continue to kind of move throughout the year. So that's where I hope we don't see, but that's definitely going to be a threat, I think, as we continue to move, because a lot of times employers are going to be late to react to macroeconomic conditions. And so what we are seeing right now could be, some of the techie jobs, some of those individuals, companies getting ahead of what they expect to be some detrimental times.
Yeah, and of course, a lot of people still haven't returned to the workforce, right? The participation rate still not as high as it was, right?
Still not quite there yet. So that's going to be another big thing. The other surprising point that we did see was that the quit rate was still pretty elevated there. So definitely we'll get updates around the participation rate tomorrow morning, I think, with the unemployment rate updates and things like that. But it's definitely an interesting time in the macroeconomy.
Yeah, I like it when there's a balance of leverage in the employment sector, for sure. It's better for all of us. So let's transition into some earnings, because there's a lot of good takeaways from some of these earnings. And of course, up first, Knight-Swift, the largest for-hire carrier by power units in the United States, represents right around 2% of the total truckload capacity in the for-hire market. So they have literally a representation of almost every single sector of domestic transportation possible. Truckload, obviously, their biggest piece. If we pull up their earnings here, you can see Todd Maiden, of course, covers these beautifully. The freaking best, I know I'm biased, best earnings reporter there is. If you look at Knight-Swift, the takeaways here, revenue decline. Pretty strong revenue decline, excluding fuel too, which has been a headwind or a tailwind for a lot of carriers. 7.2% down quarter over quarter, or I should say year over year for the fourth quarter. And that's driven, and if you look at some of their figures here, it's actually driven by a decline in volume and price. So we've been talking about contract rates not falling super fast. Knight-Swift is seeing a decline. Now, I don't know what their spot market exposure is and their truckload side, but it looks like they probably have a little heavier exposure to that sector. However, they could have just had some they could have gotten aggressive with some contracts. My one big criticism here, if I'm looking at this, Anthony Smith, is, what do you think it is? What do you think it is? What do you think my big criticism is?
Is it going to be around their tractors?
It is around their tractors. Look at them growing their power units year over year. Oh, man, Knight-Swift. I know you want to be the biggest, but this is a bad time. That was probably the worst time you could have grown your fleet. Now, I know that there's a lot of deliveries coming due, and of course, crystal balls are not handed out freely here, but this quarter over quarter, we're going to talk about a company here in a minute that did not do this and seems to be pretty stable.
Yeah, I mean, in the article, I think one of the interesting quotes here from Jackson said that he believes that the inventory overhang will clear through the spring, providing a more normal market on the back half of the year. He said conversations with customers are indicating a pickup in demand by June or July. So thinking that that's what he's looking at?
We hear this optimism, but they have to be optimistic. Yeah. You have to be optimistic. It's at this point, and again, I think it's more about not being less bad than it is being like, oh, the market's going to turn. And that's what I take away from some of this. Customers have been horrible at telling their carriers what their businesses are. Like, I would never, when I was doing an RFP, the last thing I would listen to is the customer's expectation for their year and the volume, because it was 100% wrong every single time.
That's a good point.
You obviously take what has been and you apply it forward as well as you can. That's not the best way to do everything, but I think we can certainly say with strong confidence that last year will not present itself again in terms of a deterioration, or rate of deterioration, I should say. And I want to move forward to their LTL sector, because that's going to segue us into our next earnings piece. Knight-Swift's LTL earnings. Now, this was a totally different story. If you look at this, they had huge revenue growth, excluding fuel. And fuel can be a huge tailwind for LTL because it's a percent of the freight charges instead of a per mile basis. So year-over-year change, 14.7% in revenue. Shipments per day, up 5%. This tells me that they've gained market share. This isn't just simply, but the volumes in LTL do hold up a little bit stronger through these down cycles than truckload. But this looks like they've actually attained market share. And of course, we know the pricing in LTL it's a lot more resilient, and it stays on trend longer than truckload, for sure. Not as sensitive because it's less fragmented.
And I might be rushing here, but one of the big areas that I think you noted that was of no surprise, the brokerage side.
Yeah, the brokerage side of Knight-Swift, just pitiful. 42% decline in revenue, driven by volume decline, but they're just not getting the margins. That's everybody in brokerage right now. I feel for you. I do. Quarter four of 2022 to quarter four of 2021, however, those comps may be as bad as you will ever see for brokerage. And that's because the spot market deterioration has been stupid. I showed you the NTI earlier compared to the OTRI. You can see the year-over-year comp there. It's night and day. Right. 20% tender rejection rate, we were just over 20% tender rejection rate last year. Now we're at 3.7. So there's just not enough volume. Yeah. It's not supporting the spot market for the logistics side. But back to the LTL quickly, their OR gain was tremendous, from a 90 to an 85. So extremely impressive there that the LTL sector, and I'll discount the tractor growth because one of the things they did during the pandemic was buy the LTL side of their business, and they knew that this was a smart decision. So that one, kudos to you on that. Tractor growth? Nah, let's not add any more to this. So let's move forward to our
Speaking of LTL.
LTL, kind of the benchmark LTL provider. Old Dominion released earnings yesterday, and again, this isn't quite as glowing as Knight-Swift, surprisingly, but it's actually, I think this is more indicative of an incumbent. This is what I would expect to have happened in the last quarter. So Old Dominion had a pretty decent beat in terms of expectations. If you've heard me on the show before, I discount expectations from the financial sector. They're looking at earnings per share, market fluctuations, stock value. I'm not into it. Yeah. I don't need it right now. But Old Dominion, tonnage and shipments both down. Their revenue, 17% higher.
Wow.
They took some rate increases people, and they were sticky. That is how you run LTL.
Now, this is impressive, Zach. I mean, and like you said at the beginning, the gold standard, I think, for LTL.
And if you heard last week, if you were paying attention, they just talked about their head of pricing was at a conference saying, we're not going to take rate increases next year. We shouldn't take rate increases next year. It's because they just took a ton. Their earnings just tell you. They just took a ton of rate increases.
Yeah.
They're probably are like, yeah, we got ours. We're good.
Yeah, good to go.
Well played.
And we have another one, of course, neighbors not too far down the street here, Covenant.
Yes, Covenant. So this is a fascinating study in trucking operation. The Covenant earnings came in, they were a miss, but I'm looking at their earnings, and quarter 21 over quarter 22, their revenue grew.
Yeah.
I'm sorry. That's not a bad thing. You're telling me that you built in revenue growth into the strongest down cycle in trucking history, quarter over quarter. I'm sorry. This is a operational feat in my mind.
And they did something a little bit different than Knight Swift with their tractors.
Guess what they did? They parked 600 units. Their net tractor count was down for the quarter, year over year. Extremely. Now, I don't want to get too on Covenant because this is an impressive feat. Their OR dropped from 95 to 91 over, like I said, the worst down cycle that I've ever seen. But that also tells me they were underpriced in quarter 4 of last year. And obviously their spot market exposure nowhere near. It basically non-existent. They said their brokerage arm, he said it in here, David Parker said, their current brokered loads account for 5% of the mix compared to as little as 1% when the market was stronger.
Wow.
I don't know that that's an admission I want to make. So now you're using it at rock bottom prices. He called them 1990 rates. And he does expect that to change, and they're going to replace that with some niche market stuff that gets much better pricing. But Covenant looks like as operationally speaking, a little conservative for my taste. They don't take a lot of risks. 95 OR in the strongest quarter in history, but they have weathered the storm tremendously well in last year. And it looks like looking forward, I feel good about Covenant if I were an investor.
Yeah, and it's really interesting to see, a few different companies just taking different routes to be successful.
Yeah, and this is a totally different route, very conservative route, very strong route for the current market, for sure. But they probably don't have the cash that Knight Swift has stockpiled. Again, Knight Swift at an 82 OR, and we're celebrating a 91.
Right.
But Knight Swift dropped from a 74 to an 82. So overall, but here's the last piece here. This question we get asked daily. What is capacity doing in the market? Well, Joe Antoshak, the brilliant contributor that he is, wrote this article. He did some research. He's in our research department. FreightWaves 2023 top 500 for-hire carrier list sees tractor count grow 2.63% over the course of 2022. There you have it. Capacity grew 2.63% over the last year. And it looks like it's continuing to grow to an extent because of the deliveries. But there you have it. And we have a chart here. You're looking at it. Basically, the top 50 carriers by size account for 63% of the total tractor count.
Wow.
Definitely check this one out. And this article answers so many questions. I wish we had it about a month ago when I was getting this question, I think, hourly.
Yeah.
What's capacity doing? The tractor count's important. The driver count's important. But I think considering the economically, you can get drivers a little bit easier than you could a year ago, right?
Right, 100%. And I think hats off again to Joe Antoshak here. Definitely something that I recommend you going on FreightWaves.com and taking a look at for sure. Answers, like you said, a lot of questions.
Yeah, and I mean, this is like one of the things that I'm not sure what you do with this. Like, okay, tractors grew 2.63%. You got your answer.
Yeah.
Now what?
Now you know.
Now you know. And so it's more to me about demand. And if you look at that over 2022, it's 2.63%, people. That's not that supply does not grow that fast.
Yeah.
Nor does it really decline that fast. It takes time. That's why those demand side indicators are so important, because demand, I just showed you on the chart in Dallas last 2021. I think it was a 30% jump in demand after that winter event in February.
Yeah, and I think it's going to be interesting to see what that demand kind of looks like, both upstream and downstream. A little bit earlier, we spoke about some of the downstream stuff. Upstream, some interesting things going on, especially with manufacturing. Saw the third consecutive month for contraction for the ISM PMI, showing that manufacturing is indeed slowing down now, with a reading still below 50 at 47.4. If you might be thinking about, hey, but there's those new orders component that's also contracting, still in contraction territory at 42.5, with backlogs at 43.4.
I think I'm waiting on the rate increases to stop, and I think we're going to see that turnaround. I think we're in this risk-off environment. Everybody's kind of holding their breath for the bottom. I think we've got a lot of reason to think that will turn around once we stop trying to kill it with our rate increases.
Yeah, and there was definitely, I think, a substantial amount of pull forward for sure, with anticipation.
We're still trying to vet out a lot of that noise. So I think there's reason to be somewhat optimistic. I don't think we're going to see this huge boom, though.
But this has been the show, and we're back Thursdays at noon.
Thursdays at noon.
Tell your friends. And this has been Economy Lately. I'm Anthony Smith and Zach Strickland here.